If rates aren't going to change, what's your advice for dealing with that higher interest rate for buyers and investors and even sellers who might ultimately need to buy?
So there's multiple ways to deal with high interest rates. Some of them are okay. Most of these are problematic, and some of these are going to make you sick to your stomach. What the consumer is looking for is this magic pill to make housing affordable. It doesn't exist. The only thing the consumer can do is they can get involved in local politics and do things that promote housing in their area. That's the best thing you can do. So number one, you could always pay for points to buy down the interest rate. You reach into your pocket, you pay points. Points is like a 0.5 percentage point of the purchase price, 1%, but it's always going to be between 0.5% to 3% of the purchase price, and that's going to lower the interest rate by, and it depends on income, credit, all these different things, by 0.5% to 1%, but it's very expensive. Two, you could get the seller to buy down the rate. If the market hits an inflection point because rates just shot up a little bit and buyer activity went down a little bit, do you think as an investor or a home buyer, you might get a seller to be able to kick in some rate buy downs during a market transition? Okay, now we're gonna get into the stuff that you may not wanna do. You can save and create a larger down payment. Yes, that's right, savings works. Save more money, put more down. The problem is in areas like where we live, you won't outsave the rate of appreciation unless you have a phenomenal way of doing that. Cool. Let's go borrow some money from someone. You know what? You need to pick up the phone and call Dear Aunt Tilly.
Dear Aunt Tilly.
And say, Dear Aunt Tilly. Dear Aunt Tilly is a made-up fictional person. There's no one in my life named Dear Aunt Tilly.
Do people ask about that
Yes.
in the comments?
I've gotten DMs, who's Dear Aunt Tilly? Like, how do I find my Dear Aunt Tilly? This is someone in your life that you could go ask for money who would give you the money. And yes, once again, some of these aren't comfortable. You may have to sell some of your stocks. You may have to dig into your IRA, your 401k, your retirement account. You might have to sell a toy. You might have to sell a car. Now, I'm going to be honest with this one. Your car payment is preventing you from purchasing the home of your dreams. This is true for like 60% of Americans. They have outlandish car payments. You do not need that $1,000 car payment. Go sell it, get a $300 car payment, and go buy a nicer house. This one's really creative. Uncle Sam does not care whether he holds the money or he gives you the money for your tax break for owning a home. So Uncle Sam only cares about two people, businesses and homeowners. Everyone else they want to take money from. What they do is they reward homeownership with an interest deduction. So as you pay interest on your mortgage, you get to write that off your taxes. At the end of the year, you get it back tax-free. But Uncle Sam pays you zero on your money. So Uncle Sam also doesn't care if you just claimed less in taxes. See, if the deduction's going to happen anyway, you can go to your HR, you could change your deductions, and you could get an increase in your income today. So let's just do some quick rough.
What's HR, by the way?
You're the human resource department.
Okay, got it, yeah.
Yeah, no, we don't have real jobs. I get it.
And this is HR, and this is in relationship to your W-2 income.
W-2 income.
And how much they take out of your paycheck.
Bingo.
Yeah,
So
that's creative.
So let's give them a real example. Let's say their mortgage payment is $2,600, and out of that, $1,900 a month is interest, and the rest is taxes, insurance, and principal. So you literally take the $1,900 times 12. At the end of the year, Uncle Sam's going to allow you to write off your taxes, $22,800. And if you're in, let's just say you're in a 27% tax bracket, so times that number by 0.27, they're going to give you back $6,156 on your tax return, which is nice. Well, you could simply divide that by 12, which is $513 a month, go to HR, change your deductions, have them take $513 less a month out of your paycheck, and just pay the higher mortgage payment, because Uncle Sam's not going to give you any money for it. Now, if you want to really do this, it's not financial advice. Go talk to your accountant. Your accountant can help you figure out the exact number, and you can make it happen. You could get rid of mortgage insurance. So in order to get rid of mortgage insurance, you have to put 20% down, or there's got to be 20% equity in the property. Listener, if you've lived in your home more than the last 3 years, you probably have 20% equity. And if you have mortgage insurance, I just spoke with one of our clients about this 2 weeks ago. Her mortgage insurance is $513 a month. She's lived in her home here in the Seattle Metro for not quite 3 years. So I did a quick CMA, and very easily she's at 70% of value. So she submitted my CMA to her bank and said, please remove my mortgage insurance. Let me know what else I need to do. They sent her back the documentation, said, we're looking into it. We're going to run an automated valuation. And if all that works, we'll remove the mortgage insurance. And she's going to save over $500 a month. That's a hack if you already own it. The other thing you can do is you could extend the term of the mortgage. So instead of getting a 15-year or a 20-year, amortize it over 30. We're not quite here in the US ready for the 40-year mortgage, but it's coming. The 40-year mortgage is coming to help with affordability.
I just got back from Japan. I was, of course, looking at real estate. I'm like, let's just see what the market is like here. Yeah. Right now, it's more affordable to live in Tokyo than it is here because their house prices, because it got so crazy, and they went through that low interest rates you talked about earlier. Yep. They had these 40, 50-year mortgages. And the reason I bring that up is I'm curious, like, what if we never go back to this? Would make sense to buy right now.
It would totally make sense and to buy right now. And even if it goes flat is good. The problem is it can't go flat because we're below a month worth of inventory here in the Seattle Metro. There's too many people. So another way to lower it, shop your mortgage insurance. Go shop your homeowner's insurance and make sure you're getting the lowest rate. When your property tax bill shows up, so this is for people who already own the home, go appeal your property taxes. I may or may not have just won multiple appeals and saved probably grand total 48 grand in taxes in 2024 by appealing all of those tax statements that came in.
Think about the logical reason why this is totally doable. As house prices are coming up, they jack up the taxes because they want the revenue. As house prices come down, they don't lower them very fast because they want the revenue. So you appealing, though it kind of seems like, oh, how would I get that done? It actually can get done. Yes. And I think secretly they don't want people to know it can be done, right? But if you can make the case, what you're saying is they have to kind of look at it objectively, right?
Well, and it's a hassle. So it took me, and this is what I do for a living, it took me 2 full days to submit 9 appeals. But I knew instantly by looking at them, they were completely wrong. Like in one example, it was tax assessed for $2.5 million when it was worth like 700, maybe 800 grand. I got that one reduced to 777,000. Next, there are expenses in your life that you can cut. Most often what we see is those subscriptions because you have Hulu, you have Netflix, you have Paramount, you have Peacock, you have Spotify, you have Pandora, you have YouTube. There is a few that you can cut so you can afford a better house.
You probably just saved me $100.
For those of you that have a loan, people don't realize this, but there's a process that most mortgages have built into it. It's called recasting. You pick up the phone, you call the servicer, and you say, I'd like to recast my loan. And what they do is they will kick it back out over the original term at today's interest rate with a significant down payment. So if you've paid on the home for 3 years, because they don't want to lose you to a refinance, they're like, oh, you know what, Benji, if you put 50 grand down right now, 20 grand, 100, whatever the number is, they'll recast it back over the 30 years. They shove it against the principal and your payment goes down. Most loans will only allow 1, max 2 recastings ever. These last ones are the real painful ones. You could get a roommate. You could literally go get a roommate to help pay for that mortgage. You could go rent out a room on Airbnb.
Or maybe you have a garage that could become a mother-in-law.
Put a little RV pad in next to the house. Also, you could increase your income. If you increase your income, that housing expense won't be so much. Once again, I apologize. I know all of these were not as fun as people wanted them to be.